All right, we're going to cover leverage now. So, like it said in the group, what leverage is used for, or what leverage should be used for, is capital efficiency. There's a misconception that leverage is a way of, multiplying your profits and making more money by using less. That is true to an extent, but you shouldn't be using leverage in place of money that you don't have. The real purpose of leverage is, let's say you have $100,000 worth of crypto, so and you don't want to take the risk of putting it all on an exchange, which might get hacked, or something may happen to it, or private keys get stolen, or whatever the case may be. That's why you use leverage, all right? So, or say you've got your coins and you want to use them. You want to use your coins for something else. Maybe they're in a DeFi farm or whatever. So, let's say you've got crypto that's worth 100,000, but it's locked up in a farm earning yield. Then you can withdraw. You can take part of that. You can take, say, 10,000 of it and put it into FTX, and then use leverage to trade up to the equivalent of 100,000 or whatever. So you're not actually trading with money you don't have, but you're just using your capital more efficiently. That allows you to then get the benefits of the yield on the farm, and also trade on a size that you would be trading, say up to 100,000. The mistake most people make is they want to put in 1,000 when they only have 1,000 and leverage it 100x to trade with 100,000. But they don't have any backup or any spare capital you're just putting yourself in a position then where you're going to get liquidated. It's a big problem in crypto. It's huge. It's basically what all those big flash crashes and dumps that you see, they're all designed to liquidate traders who are trading on leverage. You're playing against whales and market makers and everyone else who is way more experienced with way deeper pockets, who can take the hit of going down 5% in the space of 1 5-minute candle. That is how they're going to get you, because it's very simple that if you're leveraged 100x, a 1% price move is going to liquidate you. If you're leveraged 50x, 2% price move, and so on and so on. So even down as low as like 2x or 3x leverage, that's the absolute maximum that most professional experienced traders use. And again, like I said, they only do it as a way of gaining capital efficiency. In crypto, even using 10x leverage is risky, because a 10% price move can happen way faster. It can happen faster than you can react to it. But that being said, I'll still show how to use leverage on FTX, obviously assuming that you're somebody who has the capital and wants to not be holding it on the exchange, which is a smart way to do it. Just hide that. So here you can see I've got a test account with some funds loaded into it. And on FTX, it's very simple to manage your leverage. Your leverage is here. You can see it's automatically set to 1x. And you can edit it however you please. All right. 5, 10, 20, all the way up to 50, 100, or 101x. And you can see that when you go above 50x leverage, it increases the fees by 0.02%. So it's going to cost you more to place trades, okay? And again, 100x leverage will increase fees again by 0.03% and put limits on overall position size. So the only markets excluded from that are BTC and ETH for the 100x leverage or higher with increased fees. But all fees will be at least 0.02% higher if you go above 50x leverage. Okay, you have to confirm that, and you can change your leverage to 50, 100, or 101. All right. Again, we don't recommend doing any of these, but I want to just show examples of how it works. Okay. You'll notice that when you change your account leverage, your maintenance margin requirement changes. All right. So this is a very important number to keep track of, because just because I put on just because I have, say, let's say $2,000 in my account, doesn't mean that I can just automatically put on a $200,000 position and trade it as if it was that. The way it works with high leverage is you have to have a certain amount of margin available in your account, or else the liquidation engine will start to liquidate your position automatically, and there's nothing you can do about it, and you're gonna lose money. So if you have a maintenance margin requirement of 0.6%, what that means is whatever your position size is, your account must hold 0.6% of that. So let's take an example of you want to use your 2,000. Okay, let's just put it to 100 for ease of understanding. You put your 2,000 in, and you want to trade with 100x. So you want to trade 200,000, and if you put that 200,000 on at the current price, you get a notional size of 5.9378 Bitcoin. To have that position open and to avoid it from being liquidated, you need to have a maintenance margin of at least 0.6%. All right, 0.6% of 200,000 is the way you would calculate that. So obviously 1% of 200,000 would be your 2,000. So 0.6% would be slightly less than that. Slightly less than that. It'd be something in the region of 1,200, I believe. So you'd need $1,200 in your account to maintain that balance open. So that means that when that trade gets placed, you don't really have the safety of the trade going down as much as you think. So if price moves by 1%, you're already gone. You're already liquidated. Because as the price moves down, your collateral also goes down. So you're going to be putting your position at risk right away. And as soon as that collateral falls below 1,200, it's going to start liquidating your position. So it's not as simple as I can just put in 2,000 and trade on 100x. As the position goes underwater, so as your trade goes underwater, say you're trading it and betting that it will go up and it starts going down, it's going to take down the price of your collateral as well as put your position into negative. So you're going to be more likely to get liquidated as you go down. Then, and obviously with 1% moves in crypto, that can happen, in seconds. So it's not a smart move. And it's not what leverage is meant for. Leverage isn't meant to gamble with money you don't have, as I said before. But if you want to take a more conservative approach and understand where leverage can be useful, let's say you've got $20,000 and you want to only put 10% of that on exchange to avoid risk, the risk of hacks and counterparty risk. You put it on the exchange, okay. So you want to then use your 2,000 to trade it as, let's say, 10,000. So you wanted to put $10,000 into Bitcoin, and but you didn't want to put all your money on the exchange. So you do 5x leverage, and you use your 2,000. With 5x leverage, that means you can put on a position size of 10,000. Now you can buy your Bitcoin with that. And that will mean that you can effectively own 10,000 worth of Bitcoin without having to have that money on the exchange. And you're fairly safe from any crashes or liquidation events, because you can see here that your estimated liquidation price would be around 28,067. Because you're leveraged by 5 times, so that means you've used 2,000 to make 10,000. That means that price would have to move by 20% to liquidate you. So if price suddenly dropped by 20%, then you would start to be your position will be underwater. But even though crypto is volatile, that's a fairly conservative amount. That's fairly safe. And if price were to start dropping, you would have enough time, or you should have enough time, to add more funds to your account so that you wouldn't get liquidated. But again, there is always that risk. Crypto can go 20% down in the space of an hour or less. So again, even 5x would be kind of on the borderline. We always recommend trying to stick at 3x at the most, and putting just being safe with it, or sticking to purely spot. The other thing important thing to note about using leverage is if you're holding other coins on the exchange. So this is a big risk that people take, where they hold their crypto assets on the exchange and use them as collateral to then trade on leverage with other crypto assets. So you hold your Bitcoin on the exchange and you use your Bitcoin. Say you've one Bitcoin in exchange, that's the equivalent of $33,000. And then so you use that $33,000 of collateral, all right? And you use that to place a trade on Ethereum for a value of $33,000. That means you're essentially leveraged up, so you're kind of 2x leveraged. But the risk of that is that crypto is so highly correlated that if the position goes down, so if your Ethereum position starts going down, chances are it's because Bitcoin's also going down. So then your collateral is losing value at the same pace or faster than your position size is, and that's can lead to you getting liquidated far sooner than you expected, and even sooner than the estimated liquidation price was. Okay, if you're using collateral that's not US dollars, you have to remember that there's going to be a thing called negative convexity, which basically means that as the price of the asset drops, so does the price of your collateral, and you're basically losing money twice as fast. It's not quite that simple, but pretty much. So that's something to be wary of as well, and just to be really careful when using your collateral, your other coins as collateral. So that's everything basically on leverage. Look, as we said, the main message from this is not to use leverage unless you are somebody who understands the risks, knows how to allocate capital efficiently, and actually has that money. Do not use leverage to trade with money that you don't have. Crypto's volatile enough. I mean, it moves. Coins move, hundreds of percent in a day. Sometimes look at Axes; it's up 100% just since yesterday. You don't need leverage to trade in crypto. It's already a casino, which is of crazy volatility. So if you can't make money with the 50% changes in a week or 20% changes in a day, then maybe there's an issue with your trading strategy rather than leverage. It doesn't have to be done on leverage, because if you get stopped out or liquidated, it's going to end up costing you way more, and it's harder to make that money back when you lose it. So stick to spot. You can never get liquidated until you learn the ropes and you understand more about how to manage risk. All right, we're going to do a quick video on how to short on FTX. So a lot of people, and I see this quite often, where they know how to long, and they know how to place buy orders, and they're very comfortable with buying crypto and betting on the price to go up. But when it comes to shorting, they're confused and it doesn't make sense to them. So really, there's no reason for that, because it is as simple as shorting is just the complete. It's just the opposite of longing. If you're shorting something, you're betting on the price to go down. It's functionally the exact same. I think people just have a mental block around it, maybe because a lot of people inherently just want the price to go up. Crypto, it's, obviously that's like the kind of meme that everyone makes, that it's up only and crypto just only goes up and it goes to the moon. But we've seen clearly that that's not the case. And the majority of trades that I take are short trades, not because I'm inherently against crypto or anything like that. I just find that it's a style of trading that works for me. And I tend to be quite good at spotting when price is going to come down rather than when it's going to go up. And also, at times, it can be very profitable because you're on the other side of the market. If everybody is buying and everybody thinks price is going to go up, what happens whenever there's no more buyers? It's not good to be in a crowded trade. You don't want to be in a trade where you're the only person, where there's nobody to kind of buy after you. If everybody's buying and then you buy and you're the last buyer, well, price can only go one way. So shorting is an important thing to understand. It's obviously got risks as well, but just like longing, with correct risk management, it can be a profitable way of trading. So to place a short trade is really simple. Okay, let's say this is a good example right now as well, and I'm going to open up the chart larger, and I've got these little tabs. If you play around with FTX as well, you can figure out these. You can add this little toolbar where you can have the chart open and you can place your trades, sell or buy orders directly in the chart. And it's really easy too, because you can click this and it brings up the panel where you can do all the orders that we talk about in the other video, which is market and limit and stops and everything. But for now, let's just show this trade. So a good example is Bitcoin has been going up, for the past 3 or 4 days. It's been doing a short squeeze. So shorts have been getting really, really wrecked on the way up. Price keeps climbing and climbing and climbing. Looks like it's never going to pull back. But if you're somebody who has been studying the market and your thesis leads you to believe that price is due for a pullback, you can place a short order. Okay, so you can do that by either entering a market sell, which is if you haven't seen the order type video, go and watch that. You could place a market sell order, which would be sell market, and you could place, say, 1 Bitcoin. Okay, and you would place that. I'm obviously not going to do that right now, but you could place a sell order of 1 Bitcoin, and that would immediately open up a short position. Okay, it's no different to if you had to just press buy market. You would then be in a short position. So you would have your position on here. It would be red instead of blue. And for every dollar the price goes up, you lose money. For every dollar the price goes down, you make money. It's really that simple. Now, the difference in obviously shorting and longing is if price goes up, a certain amount, your position is going to go underwater and you're going to be losing money. So you want to have a defined risk and a stop loss. And the way you put a stop loss in for a short position is by using a buy order. Okay, you can see on this little bar, I can click here. You do buy, stop at the level that you want it to go in at. All right, and you put that in. That order, that buy stop order, would mean, let's say I was short from here. The buy stop order would mean that if we're wrong and price pumps, when it hits this level here, it's going to close the position and I'm going to take my loss. And then similarly, on the other side, if you think, okay, well, price has gone up to here, I think it's due for a pullback, and whenever it breaks down, I'm expecting it to fall back into this zone here where it's been consolidating for a while. So you want it to fall in here. So you said, okay, well, I'm going to put in my position at 32,618 and we'll go back out of it because the panel in there doesn't have the take profit option. So you want to go, okay, well, I want to take profit by buying, because you have to buy back your position when you short. And I want to put it at 32,548. And you would put in one, it won't allow me actually because of in 2000. It won't allow me to put in more than that, obviously, because of leverage. And that will put your buy order in. And then whenever the short would reach that level and hit there, it would take profit and you'd make the difference. So simple as that. When you sell, I think what confuses people as well sometimes is that how can you short something? How can you sell something you don't own? I think it's quite obvious people can understand, okay, if I buy Bitcoin, then I own that Bitcoin, and if it goes to a certain price, I can sell it and I make the profit. But how can I short something? How can I sell something I don't own? And it's basically, it's just that you're borrowing it for that period of time. But in that perpetual markets, that doesn't even matter as well, because whether you're buying or selling, it's never the physical asset. It's never the actual thing. It's just a cash equivalent. So as long as you've got money in your account, you can bet on price to go up or down, and think of it more just as a prediction rather than actually buying and selling. So that covers shorting, I think. And if anyone watches this and there's something they're unsure of, just let me know, and I'll cover it again. But yeah, that's the basics of how to short. This video is going to show live trade management and what the various order types mean when you're actually in a trade and you're looking to exit. Okay, so let's say you're in a position, and for the sake of this, I'm going to enter a position at market. All right. So we've sold, and forgive me if the connection's quite slow on this stream, but we're now in a position and it's live. Okay, so you can see we've gone short, and I want to show you what the various things do. So when you're actually in the position, you've got a few different options. Okay, so you can either manage your trade from down here, which will allow you to close it and see all the details. But what it covers is the side you're on, the position size, which is the most important thing, the notional value of that in dollars, your estimated liquidation price. So if price hypothetically went to that level, you would get liquidated if you didn't put a stop loss in or take profit or anything like that. And current price and the price that you entered, okay, which is also the same as your break-even price. The easiest way of exiting a trade, if you need to in a hurry, is just a market close from here. Okay, so if you hit market close, it'll ask you, are you sure you want to close your position? And obviously, if you press yes, it's going to put an order in at the market to take whatever the best price is to get you out of the position. Okay, so do that if you're in a rush and you don't. If you need to get out of a position and you don't want to wait for a limit order to fill, do that. All right. More commonly is you're going to place an order to actually get out at a reasonable level. So let's say here I wanted to get out at a little bit better than what we're doing at the moment, 41,506. Very simply, you could just put in 41,506. You can either do it as a limit order, but the better way to do it is to do it as obviously a take profit order, and that'll mean that when price reaches your level, because obviously we've gone short, so price has to go down for us to fill, is you would put that on the books. Okay, so we've got reduce only and retry already ticked from, if you don't understand these, watch the video I've posted just previously, which explains them. And then you put that in, okay, and that order will go on the books. And then if price hits that level, it'll enter a take profit order at the market. Note that while you're using a take profit order, it will place the order at market. So you'll pay slightly higher fees for that because it's a market order. If you wanted to put the exact same order in, but have a better chance of being the maker on the position and end up with less fees, you can put a limit order in, exact same, reduce only, same size and everything, and you can press buy. And if you're in an order, that should place and allow it to go on the books as well. Okay, two ways of doing the same thing. Just make sure you put reduce only in. That's the only thing you need to worry about in that situation. The other thing you can do while you're in a position is, I will clear all this so it's more obvious. If you want to place an order at a certain level, let's say you've got, a complex position on or a number of positions and you've got a larger size, whatever it may be, and you want to automatically calculate, say it's something like 0.01234, where it's just a number that's random and you don't have the time or accuracy to type it in correctly, which will happen from time to time. You can use this automatic tab to close position. All right. What that's going to do is, if you pick your price first, so we'll do that, 41,506. And I've had a question about this. So the first thing to note is, if you press this position, don't worry, it's not going to close your position automatically. Again, it's a little problem I have with FTX. I do believe that they make a few things less clear than they need to, because it's reasonable to expect that if you press that button, you would automatically exit your trade. Don't worry, that will not happen if you press close position. All it does is it automatically fills in the position size that you have and makes it reduce only. So this is the best button you can use if you want to place that order to exit, if you want to exit your whole position, because it automatically puts in the right amount and it puts in reduce only. Then you can hit buy and it'll put it on the books, and that'll be exactly the order you need, okay? The same way alternative of that is, if you want to exit the order now at the best price possible, obviously using market close is the best way of doing it. If you're doing it through the order book here, it's as simple as doing, maybe that's going to tab over, is it? Yeah. It's as simple as doing market order. I'll just clear this so you can see how it actually changes. You go market order, close position, and buy, and that'll close out the position, okay? But that's functionally the same as doing this, so it's probably easier if you're going to do that just to use this market close button down here. And I think that's pretty much it for now. So yeah, I'll post this one up alongside the others. Watch all the videos. If you haven't watched the 5 other FTX videos before this, I would watch those first. But yeah, and that should answer any questions that you would have. Okay, there seems to be some confusion among students about exactly how entry, stop loss, targeting, and the risk reward, and especially the term hour, half hour, quarter hour, whatever, are when it comes to my signals. So I'm going to explain this, but I'm first going to remind you that this is all completely detailed in the pins that I continually tell people to refer to. Every term that I use is explained. The sizing that I mention is explained, and if you're ever stuck, you should refer to that. I'm going to do a video because some people are more visual learners, and that's fine. We can do it that way as well. So I'm going to use this long scalp BTC long scalp as an example, okay? So when I post this, I tell you where to enter, I tell you where to put your stop loss, I tell you what the target is, so where your take profit order goes, and I tell you the risk to reward of the trade. Okay, so let's visualize that first. 40,000 entry, 39,500 stop loss, 41,000 target. If you simply go to your FTX account and pull it up to here, I'll clear some of this. I'm using FTX because that's the exchange we recommend. If you don't use FTX, you need to figure this out for yourself. It's the same principle. It will not be much different. They're all broadly the same, but I am not going to do tutorials for every exchange, so do not ask. So
every exchange should have a tool like this, which is just a position sizing tool that allows you to put in the entry price, 40,000, the stop level, 39.5, and the target, 41 for this example, okay? That gives us a risk-reward ratio of 2, as you can see here. 2 risk-reward. That's where the 2R comes from. It's very simple. If I was, and I picked this because it's as simple as possible, if I was to risk $500 going from 40,000 down to 39.5, and I was to get a reward of 1,000, which is 40 to 41, 500 divided into 1,000 goes twice, which is 2R, okay? Now, below that, I talk about the size of the trade being half R. So if we refer to the pins again, size, what does 1R mean? 1R means a full size trade per your rules. So, example, if you use 2% of your scalping portfolio per trade, then 1R equals 2%. It does not mean to fully size your trade with your entire portfolio. That's just dumb. You should know this, but I'm going to repeat it. When you trade, no matter if you have $100 or $100 million, you trade with a percentage of your portfolio each time. Me, personally, I scalp with 2% of my portfolio per trade. So for me, 1R equals 2%. That dollar figure, and I never think in terms of dollar figures because that figure always changes. If I have 100,000 in the account and I win a few trades and now I have 120,000 in the account, my 1R is different in dollar terms because it's still 2%. Whenever I had 100,000 in my account, the 1R was relative to $2,000. But whenever the account has grown in size, so does the dollar value of that 1R. So always think in terms of R instead of dollars. And so what you do is you look at what size your portfolio is right now. So let's say I'm using this account here as an example, which I've loaded some money into. There's $100 in this account, okay? If you logged in and you had $100 in this account, you would then calculate, okay, 2% of that, i.e. $2, that's my 1R. So when Michael puts a trade on and gives a signal, I'm going to trade based upon that. So then I post this trade. It says to use half R because it's good practice to not enter your position fully at once. Okay, you can see then below where we had an update that I bought another half R. Okay, this is an example message. But the reason for that is that if you enter your entire position all at once, you're essentially FOMOing in. You're essentially saying that the price you're about to get is the best possible price and there's no way it could go more in your favor. That's basically just bad emotional control. It's always better to enter a half and just see. Give it a few minutes, see how price reacts. And you might get a better entry on your second half, or you might get some new information that tells you more about the trade. So it's just a good practice. You'll see me rarely do I enter the full 1R in one go. So we've got 1R, and this trade is half R. So we're back to your example. You've got a $100 account. You've got 2% of that, which is $2. And I've said to trade with a half R position size, which is $1 for you. Okay? So $1 is your total risk. That means your entry, which goes at 40,000. So we've got a bit of buy order at 40,000. Okay? And your stop loss would be at $500 below that on the chart. And the total risk you could have is $1. So you have to divide 1 by 500, okay? Because that's your total risk divided by the swing you can have before you lose. So 1 divided by 500 is 0.002. So you copy that. Go in here, go to your position tool. You want to change the price to 40,000. Oh. Okay, your stop loss, your position size, which is 0.002, which we figured out by dividing. You know the distance, so you use your tool. You know the distance is 500. You know your position at 1% of your portfolio because your 2% is 1R, so 1% is half R. You know that the size is 500 and you divide 1 by 500, gives you 0.02. You then put in the stop loss that I give you, which is 39,500. You then put in the take profit, which is 41. Okay. You can see here that because of the way the chart is at the moment, it's not showing up on here. So what I'll actually do, just for the purpose of this working, is I'll take the exact same concept, but I'll move it down below the current price so that it shows you visually. So instead of 40,000, I'm going to say 20,000, just so you can see it. 20,000, 21,000 as a profit, and 19,500. Okay. Oh, it's not going to let me do that either. All right, well, I think you get the point. The point being that when you divide 1 by 500, you get 0.002 as your position size. That is the only way that you calculate your position size. So when I say to use half, it doesn't mean that you slide this. It doesn't mean you slide this up halfway. It doesn't mean you press 50%. Because what this is doing, this tool, is adjusting leverage based upon your total account. Your total account is 100, and you can see here that at the moment, my position leverage is set to 100x. So if your position leverage is set wrong, and you press 50% thinking that you're going in half, you're risking $5,000 on the trade when you only have $100 in your account, so you're going to get liquidated almost immediately on a small move. So this slider, this bar is not relevant. What's relevant is the position size that you trade with. So 1R is equal to 2%. Whatever your portfolio is at that time, find 2% of it. That's the total amount you can risk. So that if price travels from your entry to your stop loss, it must not exceed more than that 2%. It's as simple as that. All right? So I hope that clears up how things work, why I use half hour, why I use quarter hour instead of just a full position, and hopefully that makes things a little bit easier for you all. All right, guys, doing a follow-up video to show a little bit more about some of the FTX orders after I've been speaking with some of you guys. There's a little bit of confusion around how they work. So I've got a test account here and I'll run through them. So in my previous video, I showed you how to place orders, buy and sell, so how to go long and short, and what the order types meant. So we went through the limit orders, market orders, trailing stop, take profit, and everything like that. So if you haven't covered any of that, just jump across and watch that other video. But what we want to look at now is the different finer details of some of these order types here. So everything on FTX has a tooltip. So if you hover over it, it will show you. But I'll explain them because I do appreciate that some of these things are quite confusing, and you've always got that fear when placing an order or when you're actually live in a trade that you don't want to press, any buttons in case you do something wrong. So it's completely understandable. So what I'm going to do is enter a trade and then show you guys what the different buttons and everything do. So let me just see what the best way of doing this is. I'll show you a couple of different ones. All right. So one thing you can do is when you're placing a limit order. So let's say we're up here and I think, all right, Bitcoin, they've wicked up here like 3 or 4 times here. 1, 2, 3. So they're clearly going and collecting buy stops. So they're trying to stop out anybody who's trying to short this. So you see this breakdown? Everybody shorted it. So they're setting buy stops. They're wicking into the buy stops to get liquidity to go lower.
So I think it's going to go lower and probably go after this area here, because that's an obvious place where people are going to place their stops if they're longing here, thinking we're going to break out over the weekend to 43K or whatever. All right. So, that obviously that doesn't matter for the purpose of this explanation, but I wanted to just show you my thought process about why I was going to place my buy order. So I'm going to put a buy order here at 41164. All right. So if you do that and you use the advanced order book, which is this one, or order form, sorry, not order book. This is the order book. The advanced order form, 41164. That'll put your buy order in for here, and that's a limit order. Remember what we said from before, limit order is an order to execute when the price gets hit. Then we want to put in a stop loss. We always put in a stop loss. You don't have to put in a take profit target when you place the order, but you always must put a stop loss in. Whether you're going to use it at that exact level or not is irrelevant. The stop loss has to go in to protect you from the exchange risk. Okay, the exchange might go down, your connection might go down, everything might crash, especially when things go wrong. When Bitcoin crashes, everyone goes onto the exchange trying to sell the position, and it overloads and the exchange freezes or breaks. This happens all the time. So always put a stop loss in. And where I would put my stop loss, let's see if things going a little bit slow. But just for the sake of this, I'm going to say, all right, well, we're at the weekend. We're going to go hunting for stops. We're probably going to clear this out. But I don't think we're going to go right the way down to below here. All right. Not right away anyway. So I'll put a nice wide stop, and I'll put the stop down at 40229. All right, and we'll put in the order, say half a Bitcoin. All right. So what I want to look at here is these reduce order tabs. So I've shown you how to place a regular order before, but this reduce box, okay, if it's ticked, and it will automatically be ticked for take profit and stop loss. This means that the order you put in for stop loss, okay, which I'm going to do now, by ticking the reduce button or checkbox. Oh wait, sorry. Oh yeah, because I've got a test account with money in it, but I'm not using leverage because, as we said, we shouldn't be. So let's just see what I can put on. Yeah, all right. It's irrelevant anyway. I'm not actually going to place the position here. All right, cool. So here we have your buy limit order, and if we drop down, you can see your sell stop. Okay, so because I put reduce tick here, that means that it's a reduce only order. So that means that when price reaches here to stop, it will only sell the position if you have a position open. It won't open a new position. Okay, it's a reduce only order. All right, it means it will only reduce the position. It's fairly self-explanatory, but it's important to note. The alternative would be, if you're in a trade, let me see, I'll bring it back to this order form here because it shows them. Reduce only orders will only reduce your overall position size. They will never increase your position size or open a position in the opposite direction. Okay. Why would that be important? You might be asking, because if you place an order and you place a stop, then surely it can only either hit the stop or not. But that's not the case. If you were to do this, okay, so let's say we just use the quick form and we put a buy order in. This is what a lot of people make mistake with. Okay, so they put their buy order in, then they put their stop loss in, and then they put in their, let's say, their take profit, which would be a limit order. All right. This is where you can end up having positions get way out of hand and get liquidated without you even knowing. So the reason for that is, what I've just done is just place naked orders on the books. I haven't placed reduce only. So that means if price comes down and hits my, oh shit, yeah, I'm gonna get all that off. I've got too many things just written on it from earlier. But if price comes down here, hits my buy limit, great, and then rallies up and hits my sell stop, brilliant. Trade wins and you make profit, okay? But let's say you aren't a regular trader and you don't look at your account again for another week or so, and you haven't cleared this sell stop. That means price can come the whole way down here, hit your sell stop. It will open a short position. And then if price reverses and rallies and goes up to 45, 48, 50K, this is going to be a short order that's open without you even knowing it. It's going to liquidate you if you're not aware and price moves in the wrong direction. Okay. So let me clear this again. So that's the importance of a reduce only order. Okay. So when putting a position on, your stop loss and your take profit should always be reduce only. The buy limit, your order itself doesn't have to be reduce only. In fact, it can't be reduce only because by its very nature, if you don't have a position on, so no, at the moment I have no positions on, so I couldn't make this a reduce only order because there's nothing to reduce, right? So if you're ever putting a single order in, so if you're not using this form, if you're just using this form, which happens quite a lot, this is pretty common where, let's say you just bought some Bitcoin, on a swing trade, and maybe you bought it at 40K and you're holding it for a number of days or weeks, or days up to a week maybe, and you're not ready to put in your take profit or your stop loss just yet because you're not using leverage, so you're not at risk of getting liquidated. So you don't want to put a stop loss in just yet, and then you come along after to put a stop loss in. Okay, so maybe a day later, once you've seen how the market has moved, that's when you would use this form where it's just a single order. And you want to come along and you want to put in your stop loss and say, okay, I got in at 40K. We're up now at like 41.7, and I'm fairly confident that we're going to keep going up, but I also want to lock in some profit. So I'm going to put in a stop market order at 41,000. All right, so that if we come to 41K, I'm going to get stopped out, but I'm going to have made my profit from 40 to 41K. Okay, great, good idea. Smart risk management. 41,000, you put it in here, you put in your amount, and you put in reduce only. So you click reduce only to avoid that issue that I mentioned, where if price comes down and touches it, you only close a position, you only reduce a position size, you won't open another position in the other direction. Okay, you can put that on the books then, and that'll go on and that'll keep you safe. Retry as well, so you can see here. Retry is always going to be automatically selected, and you should always leave it as that, unless you've got a really thorough understanding of how to trade. But you wouldn't be watching this video if you were this advanced. Retry means basically, as it says here, it'll continue to trigger that order until it gets fully filled up, the position's fully closed. Again, this is risk management. A lot of times when things get really crazy, the books can get thin, which means market makers can pull liquidity, which means there's not as many Bitcoin available for sale or for purchase, and or people willing to purchase, right? And that means the price can move sharply. That's where we get these big wicks and liquidation events that we get. If that happens and you don't have a retry order on, it's going to attempt your order once. If the order fails, then it's going to cancel it and leave your position open. And if price keeps moving against you, you're going to get liquidated. So always have that marked on. It's going to be anyway, so just don't turn it off. Now, the other one is, if we go to it back to the regular limit order, you can see these other two, post and IOC. So just to mention, first of all, I don't use these very, very rarely, and you shouldn't either. Again, they're much more advanced, but for the sake of this video, might as well cover them. A post order means that it's guaranteed to be the maker on the books, okay? So what that means is there are two, as I've said in my other video, there are two order types in any market. There's a maker and a taker. Okay, so for you to buy Bitcoin, somebody has to sell it to you. And if you decide to come along and buy Bitcoin, you're going to be buying it from orders that are already on the books. Okay, and those are generally going to be market makers / makers. Okay, so they don't have to be a market maker by definition, but in terms of a trade, they are the market maker. So they're the maker, you're the taker. If you're going to put a limit order on, it's not always guaranteed to be the maker, okay? So generally, a limit order is the maker, a market order is the taker. If you don't understand that, watch my other videos where I explain it. So generally, a limit order is the maker because it rests on the books. You put a limit order in that goes here with all these. These are all limit orders. You can see the total amount of them. that's limit. It's resting. It's waiting for somebody to come along and take it. Okay, so if somebody comes along and takes it, then you are the maker. Somebody comes along and takes it by placing a market order. But again, in times of high volatility and in times where things are orders in more demand than usual, you can't always guarantee that you're going to be the maker. You might have to take a little bit of slippage and become the taker. Okay. Again, it's not something that you need to worry about, but you basically only put this on if you want to guarantee that you'll be the maker, which means you pay lower fees and you get that exact order type that you wanted. Okay. The downside of this is if it isn't immediately able to make you the maker, it will cancel the order. Okay. So your order won't get filled. So again, don't recommend using it. Don't touch it. But for the sake of the video, I wanted to cover it. Immediate or cancel orders. It's the same thing, only flipped. All right. So it's guaranteeing that you'll be the taker. And if it doesn't immediately execute, it'll be cancelled. Okay. So just the exact same as this, except it would guarantee that you're the taker instead of the maker. This is getting into more complex trading, trading systems and professional traders and why they might want to use one or the other, professional traders or market makers. So again, it's not something that you need to worry too much about. This little button here just flips between buy and sell. I personally don't know why they bother using it, but just in case anyone is wondering, because I know some people are afraid to click this in case it does something. So all it does is just toggle you between buy and sell. And see if there's anything else before I finish up. This video is getting quite long, so I want to finish it now for you. That's pretty much it. Yeah, that's everything. Everything to do with order book, the order form. Sorry, I keep saying order books. And yeah, that's it. All right. Cheers, guys.